All right. Welcome to Falcon Forward. My name is Peter Brecht. I'm here with Mike Tanghe. Mike, how is your Thursday morning going?
Thursday is great. Having a good week and just having a good day. Thank you for asking. And
Yeah,
yours?
yeah. Awesome. It's going okay. We're still up in Lake Tahoe. We saw a brown bear yesterday. The kids were very excited and over the moon about that and
Oh, that's
just keeping
cool.
things going. So they're out. I don't know what they're doing today, actually. I have no idea. They just know the dads at home are here doing things and they're out doing other fun things. So it's good.
Yeah, excellent. Excellent.
Yeah. Great. Well, today's topic. So this is one that when we were talking about it in the pre-show, the pregame here, I was just kind of caught off guard by it in terms of how timely it was, and so there's a lot of conversation right now in kind of the private equity space and raising capital and all these different macro factors going on, and so wanted to kind of translate that into insurance terms, and here you are with that very concept. And so, very excited to kind of jump into it today. So, I'm going to turn it over to you. My voice is kind of gone. So, I'm going to let you do most of the talking on this episode.
Yeah, no problem. All right. Well, thanks, Peter. So, what we want to address today is our industry has seen just massive entry from the private equity players over the past, call it 15 or so years. And in the past, insurance was this, industry that the private equity, it really ignored. They wanted to go after more manufacturing type, and insurance was just kind of one of those things. And maybe it's just that generally people either didn't understand it well or didn't like it on it. But whatever reason, the private equity people ignored insurance for a long time. A couple things that happened that made them take a look at it is one was in 2008, the Great Recession. That impacted a lot of industries, commercial real estate, housing. It was very, very bad for a lot of industries that had done very, very good for a long period of time and that had a bunch of money dumped into them in the private equity side. How did insurance come through that? Pretty good. And so people started to take notice of that and see, wow, like insurance brokers actually did pretty well. People kept renewing their policies. Yeah, maybe exposures were down, but generally strong retention, predictable revenue, that came up pretty good. Then you had something like COVID that, again, impacted a lot of industries, restaurant, entertainment, airlines. You just go through a lot of these things were, absolutely crushed because their business stopped. How did insurance do through COVID? Again, I don't want to make light that these were terrible events for a lot of different people, but if
Yeah.
you want to just specifically look, how did insurance fare with the Great Recession with COVID? Came out even better out of COVID as technology accelerated a lot of change, and customers kept having to buy insurance, and people kept renewing their policies. That predictable revenue stream kept coming. And then again, I would say COVID, and that'd be another podcast to do, it'd be an interesting topic, is how did COVID accelerate the adoption of technology in insurance? I think, maybe by 10 years or so, things that we would have been doing as far as Zoom meetings, as far as the use of more distributed models, meaning that you don't necessarily have to have people in a central office paying expensive rent and commuting and all those types of things. COVID was a massive technology accelerator for the insurance industry. So you have all those things happen, and then you see that as banks try and get more and more creative about where they can deploy money, these private equity folks said, wow, we could actually buy agencies. We could lever them up, which is the private equity model, meaning have the company borrow on that. And then guess what? We have this predictable revenue stream. We have predictable cash flows, and we can service that debt. And if we do this and buy enough of these kind of inefficient, smaller groups, bundle them up, every 3 to 5 years, we can sell that and do pretty well. That's what people have done for maybe the last 15, call it even almost 20 years in our industry. What's also happened during that time, and this is where I think maybe the private equity people missed out without their understanding of the industry, is we have been in a hard market for 16 years, or maybe 14, 15 years, call it. What does a hard market mean? It means that insurance companies generally get to set rates. It's less buyer friendly. And so people seeing, 10, 12, 20% renewal increases became the norm for stuff. And in certain industries or certain lines of business, that was even a lot worse. So here you have private equity being like, wow, we're buying these companies. If they just renew all their customers, they're growing 20%. If they can actually add new customers to that, now we're growing 20, 30, 40%. We're able to borrow money very cheaply with the cost of what interest rates were, especially coming out of COVID, when effectively you had 3 years of almost free money. And so that's a pretty good recipe of borrow money very cheap, use that money to buy a business that's growing at 20 to 30%, get all these things together, and is a model where private equity companies made a lot of money. And that's why we saw all the consolidation in our industry. Later, I'll get into why this isn't necessarily a good thing for the customer or for the insurance brokers, but that was what the industry was. And so what do we have now? Markets have softened. We've ended our hard market. And again, in insurance terms, that just mean that insurance companies are having to lower their prices to retain their existing business, and insurance companies are looking to grow more business. And the way they do so is cut rates, and they've made money, and so they're underwriting. The management allows them to do so, and so if you look at how pricing goes up for 14 years, which is an exceptionally long hard market, now things are coming back the other way on that. And so you could renew all your business, all your accounts, if you're an insurance agency, and your revenue may be down 5% year over year. So now you're having to, and the big brokers are now reporting their quarterly earnings, their most recent quarterly earnings, and it's showing that. It's showing flat revenue growth, or going into the low single digits when it had been in the mid teens. And what else happens with private equity companies? They have very short time frames. Typically 3 to 5, maybe 7 years is a typical private equity investment. And during that time, again, we can talk all about private equity, how that works. They're charging their investors for managing that money, but they have to return that money at some point. And that's the expectation of their investors, is that this money is going to get returned to them within that time period. And you also have now these loans, when they lever up these businesses and put a lot of debt on them, these loans are also 3 to 5 year time periods. So something that was taken out when interest rates were very, very low, if you're trying to refinance that debt, you're going to be looking. It's the same thing that happens like if you have a mortgage on your home and you took it out a 5-year term in 2020. That's going to be at 2.5%. Good luck trying to get 2.5% if you're trying to refinance a home now. You're going to be paying 6.5%. So same thing holds true for these private equity folks that are trying to refinance that debt. So again, these are bad things happening at the same time as an investment. The insurance industry, in my opinion, still is very great. We'll get into why this a little bit later. But if you're looking at this purely of, hey, this is an investment I had that was making me a bunch of money. Now all of a sudden, I either got to refinance my debt and my business prospects don't look as good. We're going to see, a very big impact in the industry for those companies that are highly levered, that were built on a model of we need to or keep acquiring to grow. And now, kind of the Warren Buffett quote of, who's swimming naked when the tide goes back out. And that will show. So what does that mean for us? What does that mean for if you're an insurance producer or if you're an account manager on it? So if you're working at one of these companies, it means that work isn't going to be as fun as it once was, meaning that these management, and you're going to have management that may have, grown up in the industry and, built their business on relationships, but they sold to someone else and they got a lot of money on that. And now these other people with the money, these are the new owners, they're in charge. And so when there's mandates of, hey, we got to cut hiring, or, hey, we can't, 6 months, we're not hiring anyone, 6 months, no raises, 6 months. And those are the mandates that come out with these private equity companies, because they're purely looking at this as a balance sheet. They're not looking at it as, hey, where do we invest? How do we help out our people? So if you're an account manager, you're going to be asked to do a lot more. If that person next to you leaves and goes somewhere else, that position is not going to get filled. If you're a producer, and again, you're renewing accounts at a 20% renewal clip, everyone's happy when things are making money, but they're going to look at it and be like, wow, like we're paying our producers the same for renewal business. Guess what? That's already on the books. That's already our business. Let's redo contracts and let's lower what we're going to pay producers on renewal business so we can incentivize them to try and go out and hunt new business. They're going to say, hey, you're a highly paid producer on something. We don't want you servicing these accounts. We want you going out finding new business. So they're going to change their account management model of how do we work with, as a producer, yes, making money is great. But why is a good producer, in my opinion, a good producer? It's because they know that client inside and out, and they enjoy knowing that client inside and out. And when the client, and what does all that mean? And why do I think this is one of the greatest jobs in the world is you get very entwined with your clients. And again, I've had clients now that I've worked with for 25 years, and I've seen good, I've seen bad. But my point is I work with them. Like we're talking on a regular basis. Extremely gratifying to have that level of relationship. And I think very rare in most industries that I see that you can have that level of relationship where you're truly an advisor to your client. And in these models where it's like, that is a lot of my time spent on those relationships. And why do I do it? One, because I enjoy it. One, because it's the right thing to do for the client. But the third is that I want to make sure that account renews with us on it. And if you switch that model and say, hey, Mike, go out and find new business instead of working on retaining your old, who gets hurt in that? It's the customer, because they're going to be dealing with multiple people. They're going to get frustrated because it's something that they don't necessarily understand insurance. And before, when they had, their person that they could call that understood exactly what to do. Now this customer is trying to have to explain things, or they're sending things out and it's not right and keeps coming back to them and they don't know. So it's setting themselves up for, and again, in my opinion, very short-sighted. But if you're, a private equity company and you got to make this, refinance this loan and make things look pretty on a balance sheet, those are things that they do. And we see that happen all the time with our clients. So for a producer, not as fun. Potentially job compensation cuts. And then again, that pressure of, and we don't pressure our producers to go out and produce business. We want them to, for sure. And we'll give them the tools and the support to go out and do so. But we're not going to have, Monday morning meetings where we say, what are you closing this week? And I've worked at organizations that have done that. And to me, that's not fun. That's not what I want to do. So again, I would say it would take the fun out of the job if you're in that type of environment. I'll go into a little bit of what it means for account managers, but I realize I've been talking nonstop, and I could probably insert a period now and take a breath. So
no, it's good. It's never being fun pawned off, feeling pawned off to somebody else, right? So if you are going out as a broker, and that's how we win business, like you said, is through the relationship side, right? So we want to build a relationship with somebody. And that's really kind of what we stand on more than anything else. And I think any broker, maybe they can stand on the brand name that they work for, if you're working at one of the bigger shops. But ultimately, it's the broker wants to sell themselves too, right? And if you take that component away, and it's like, hey, great, now I'm going to have you work with my account manager. We want that to be more of a that's fine. They don't have a problem with that, but they also want to know that you're still in control of everything. And if something goes sideways, or they just want to talk through something, that you're going to be able to do that. I think that's critical. The other part that's interesting that I was kind of thinking about, and you might get to this a little bit later, but with all the PE stuff too, like I'm looking at all these Insurtechs that are kind of coming on the scene, right? And they're kind of, I think, following a lot of the same patterns as the PEs are, because there's a ton of them that kind of came online in COVID and it kind of peaked, and now you're kind of seeing it taper off a little bit and maybe overheat in a sense. And so it's and everything's kind of come back to reality. I've talked to a couple other brokerages and friends that work there, and they're like, yeah, we don't use a lot of AI tech now. We just kind of use Gemini or whatever our chat tool is, and it's working fine. Like we're getting the same amount of work done. We're just not maybe spending as much on the tech. So I don't know, just a little side note there, but give you a chance to catch your breath.
No, and it's absolutely right. There's always people, and I know you do this as well, but I listen to a lot of podcasts on it, and it's something I enjoy when I'm exercising or whatever, or folding laundry. And it always just kind of amazes me when they're talking about, how can we, and a lot of it isn't like, how can we use tech to help on our existing? It's how can we disrupt, and how can we replace, and how can we, and at the end of the day, like people don't understand insurance generally. They don't like insurance generally.
Right.
They know they need to have it, and they want to find someone that they can understand and they trust,
Yep.
and they know that will just make this insurance thing easier for them. So they don't, get these repeated requests for things they don't understand, or they don't find themselves in an uncovered claim scenario. So it's like that's fundamentally what our business is how do we make things easier for our clients on it. And tech is great for that. I mentioned being a podcast that COVID accelerated tech adoption in our industry, but that was for ways that enabled us to communicate more with our client, like Zoom, for example. Zoom wasn't that it was, it's got cool filters and Mike looks better on a camera than he does when he's sitting across a conference table with him. No,
Right.
Zoom was something that allowed me to not have to jump on an airplane, spend all day, and then sit across from a client on stuff on it, where I could still have, and again, I don't discount that when we still will have those meetings with clients and we'll still do that in person. But it's much more deliberate when we do that. And we can have a lot of interim meetings over Zoom or Teams or whatever your mode is. And it allows us just, hey, I get to see this person, I get to communicate with them. And then 30 minutes later, I'm having a call with someone, in a different country or a different state or different,
Yep.
something like that. So tech in that didn't replace Mike Tanghe, and our client wasn't now just going to Zoom and going and buying insurance. It was an enabler of us to more freely communicate with our clients and have that direct connection with them. So like those to me are the things that, yes, that will help our job. And we're doing quite a bit with AI, but it's not as a replacement, or it's not something we're going to hand off to our clients and say, learn this new tech.
Right.
But it's instead, what things are we doing right now? And if we do, like for policy review or proposal creations or stuff like that, instead of the manual, repetitive, time-consuming process, can we utilize tech to generate that faster? Because then guess what? Now I have, instead of spending 2 hours on something, took me 15 minutes, and it looks better than when I spent two
Right.
hours on it. And now I can have 8 conversations with different clients rather than just one during that 2 hour period. So that
Totally.
to me is how tech will work in insurance. And again, like these things of, oh, we're going to use, and again, there's certain policies that don't need to be purchased by through a broker, the commodities, and tech's great for that. Now, do I think it's wise to raise $500 million to sell renters policies? That are, $100 kind of loss leader type policies? No, I wish, frankly, that every client would buy their renters policies via a tech thing. Problem is we still see clients who buy a policy from one of those online folks, and it's not done correctly. It doesn't have the right limits. So it's still something that we need to correct. But again, I look at this business that you raise $500 million, you lose $20 million a year, selling $100 policies. To me, just doesn't seem like a great business model, no matter how cool the website is or so forth. So anyways, I'm going off a little tangent on that side.
Yeah, yeah. No. Yeah, AI is I kind of look at it like the Iron Man suit, right? It kind of enhances your abilities, but it doesn't replace the person inside. So it's good stuff. Yeah.
Great example. I like that.
Yeah.
That's what we should
Yeah.
call our AI tool, Iron
Yeah,
Person.
well, what did he, yeah, there you go. We got to come up with something for it, but yeah, all right.
Yeah.
I love it.
Excellent. I want to add one piece too, because I talked quite a bit about like what it means for producers. But if you're an account manager listening to this, whether it's someone who's working at our company, or someone who's thinking about joining our company, these things, like, you need to be aware of it, right? You need to be aware what is the financial basis for our company, and do we have a lot of debt? Do we have a lot of debt that's coming due? Were we overpaying on things? Because in those situations, again, you need to you don't want to be the last person, the music's still playing on the Titanic and things have gotten miserable because your folks are leaving. So, this confluence of events is going to mean, more work for people. So not replacing people when other people leave, less support So again, that investment in, hey, if we want to grow our, we spend a lot of time as an agency looking at what are our growth plans, what do we need to support our team, and then investing on the front end. So we're excited to have a new account manager join us in 2 weeks on the personal lines, high net worth personal lines side. And the reason we did that is because we have a new producer starting on that, and we know that in the beginning, that things aren't going to be as busy will be effectively a little understaffed if you look at it purely on a financial standpoint on it. But we know that this producer is going to do great things and bring in more business. So, if you're working at a place that's strapped on the PE model, they're not going to hire that person. They're going to go tell the producer to produce. They're going to pile more work on the account managers. And it's only when two of them leave that they'll, bring on one replacement type thing. So again, if you're an account manager, just be aware of, how is your company being run? And does that match up with what you value? And if you're someone who values taking care of the customer, always looking out for the customer, always doing right by the customer, then that could be, you could have those values effectively being squashed by management decisions. So you'll likely see more like utilizations of VAs. Where can they cut costs? So it's one of the things that had been popular is the use of virtual assistants in other countries. What we're going to likely see, though, are those VA type positions being pushed to be completely AI. And if you're someone who's played around with it, like AI is great, but it also does some funky things. And if you're a client, you don't care how great it was for the 9 client interactions that happened before. If you're getting a funky reaction or a hallucinated response, you're not going to, again, care how great it was for everyone else or how much time it saved or blah, blah, blah. You're just going to be like, well, why is this thing telling me the wrong thing? Or worse, I act on what it did. And I've heard stories of people, prospects of ours that we're working with that are trying to get like claims resolved it's like talking to, just this black hole of repeating yourself and just it doesn't get resolved. And we see that with some mortgage companies and stuff like that it's painful and it's annoying and it's a time waster. So again, look at how is your firm utilizing AI. Hopefully it's used to enhance the service that you're providing and free up time so you can have those conversations with clients. And it's not as a means to, hey, let's replace our people and do this because it works pretty good most of the time.
Yep, totally. Makes sense. I mean, we have clients that are very specific on which account managers they like to work with, right? And it's like if so and so, just imagine if they got pawned off on AI. I can't imagine the amount. I don't know. We're a little different.
Yep. And on one hand, I highly encourage all this stuff that's going on because it creates opportunity for our agency. I love the consolidation. I love the M&A, not because that's something that we're looking to do, actually the opposite of that, but it just creates opportunities for us to bring on new clients that want to work with a broker that looks like how their broker used to before they sold. And then the same thing is we want those account managers and producers who want to work for a firm that was how things used to be on it. And again, I'm not talking about, hey, you're going to go back in time and, we're doing things, in my opinion, the right way. We'll continue to do so and welcome anyone's feedback or commentary on this topic.
Yeah. Awesome. Well, Mike, thanks for your time today. Is there anything else you wanted to go over before we close out today's episode?
That's good for me. Thanks, Peter.
All right. Well, thank you guys for listening to Falcon Forward. We'll be here again next week. And in the meantime, if you have any questions or comments, leave them in the comment section. All right. Thanks, guys.
Thanks, Peter.